And starting with the first one, high yield bonds, or sometimes these are called junk bonds. This is the biggest, most popular investment on the list. Also, probably the one we'll spend the most time on, just since they are so prevalent out there. It's such a big market and they're so common. So there's about $300 billion in high yield bonds out there in just mutual funds and ETFs that you or I can buy today. The total market is over 1.5 trillion. So this is a lot of pension funds, hedge funds, private markets. It's larger than the municipal bond market out there. So just a massive market here. So what makes these bonds different than, maybe what we have in your portfolios today? Unlike some other investments we'll look at in this webinar, these are not necessarily complex at all. They're really just simple bonds, so it's a loan that an investor is giving to a company in exchange for interest payments over time. The high yield or the junk term is really just used to describe a bond below a certain credit rating. And so what does a credit rating mean exactly? There's lots of companies out there that try to grade a bond. And so Moody's or S&P or Fitch are the big ones. They all have their own grading systems, as this chart tries to show here. Don't worry about all the details. Really, what's important to know is that these junk bonds are all bonds that were issued from companies that have below a certain rating from these rating agencies. And so there's this line in the sand between what's called investment grade, which are companies with relatively good financial health, so think Apple and Microsoft, very strong balance sheets. You can be pretty confident they're going to be able to make their interest payments. And then non-investment grade or high yield or junk, which are companies that, just not as strong of a balance sheet, potentially much riskier. And so what attracts all this money into junk bonds? $1.5 trillion thinks this is a good idea. What are they seeing? And I think for the most part, especially for retail investors, it's looking at these yields that these bonds offer. And so for the next few slides, I'm using a fund from iShares. This fund has the ticker symbol HYG just as an example. This is the largest junk bond ETF out there today. So I'm not just picking some obscure fund. This is a very popular one, tens of billions of dollars in assets. And right now, potential investors in this fund are looking at a yield somewhere over 7%. And that's great, right? What's not to like about a 7% yield today? To begin to understand why we don't believe these funds need a place in your portfolio, first I want to look at what the historic yield of these types of bonds have been over time. And so here's a chart from the St. Louis Federal Reserve, and it shows the yield of a junk bond index since April of 2007. And I picked April 2007 because that fund we just looked at, HYG, was launched in April of 2007. And so over time, you can see here the yield that bonds in this fund have had over time. Started around 7.5, pretty close to where it is today. Financial crisis led to the yield really increasing. And maybe just a simple point to make here, I put a line at about 5% on this chart, and you'll see why I picked that level in the next slide. But for now, just notice that for almost the entire time this fund has been in existence, since 2007, the yield on these bonds has been over 5%, and many places well over 5%, right? And so if you purchased this fund in 2007, held these bonds, this fund should have been tracking this yield over time. And so here's the big question. If you purchased this fund April 2007, collected these yields, what do you think your average annual return would be since 2007? Well, thankfully, the SEC requires funds to publish this performance. And this is a screenshot directly from the iShares Fund website. Since April of 2007, this fund has averaged an annual return of 4.75%. you'll notice that's much lower than what the yield was for just about the entire time this fund's been in existence. And so why is this so much lower than the interest, the yield that investors have been receiving in this fund? And that's because yield only tells part of the story for how these types of investments perform for an investor over time. And what we also need to consider, especially for risky investments like junk bonds, is how many of these companies are defaulting and causing investors to lose their principal. And so there's lots of studies on this, tons of data here. This is a chart from a massive study from Moody's that looked at different default rates. More information than you want, but what you should know is that it's not uncommon that junk bond issuers default, go bankrupt, restructure, can't afford to make their payments. From 1982 to 2015, a long-term average was about 2.5% of these companies default every year. And of course, that spikes in times of kind of financial turmoil. It got up to just about 9% in the coronavirus pandemic. I think 2008 and 9 had about 7.5%. And what this means is that investors in these funds are getting a high yield. They're also losing their principal pretty consistently to the tune of, about 2.5% every year. And so this is just a chart that shows this another way. And this is the chart of just the share price of HYG, that ETF we've been looking at since April of 2007. You can see that even after more than 15 years, an investor who purchased this fund in April of 2007 now has their principal down about 25%. And so this is taking a huge chunk out of their total return, and a big reason why they're just getting that 4.75% in the long run average annual return. And so besides this default dynamic, there's a few other things to know about these funds that just lead them to not be great long-term investments. First, the fees on these funds are going to be much higher than what you're used to with a basic bond fund. There's probably lots of active management that needs to go, trying not to pick the companies that are going to go bankrupt. And so Morningstar says the average fee for these funds is just under 1%. That fund that I was showing you is one of the lower cost ones, about 0.5% in their fee that they charge, but still 0.5% every year in fees is really going to eat into your long-term return. And consider you can buy, a US investment grade bond fund or a treasury bond fund for maybe 0.05% or less. And so even though these junk bonds have higher yields, when you start paying 0.5% towards fees every year, that kind of eats into that added yield there. And also, if you buy these funds outside of a retirement account, IRA, 401k, or Roth, you're going to be paying more income taxes, compared to capital gains or dividends. You're paying the income tax rate on any interest, which tends to be 7 to 10% higher rate than you pay on some income you can get from stocks. And so finally, just as part of the bigger picture, how do high yield bonds fit in your portfolio? And the problem is that high yield bonds just have this they're in this unnecessary middle ground between two very good types of investments that you already have access to at very, very low expenses. That's stocks and investment grade bonds. High yield bonds have outperformed their investment grade counterparts over time, but they've also significantly underperformed stocks. And so this chart here is just to show the long-term performance of high yield bonds compared to US stocks, and then compared to an investment grade bond fund, which is just called a total bond market in this chart here. And also, high yield bonds tend to be very correlated to stocks, just meaning that when stocks decline in value, so do high yield bonds. And so that's pretty different from higher quality bonds that tend to have a little bit more stabilizing effect, tend to not do as poorly when stocks are doing poorly, and can just lead to not as much diversification in the portfolio. And that I'm just trying to show by this chart here, which shows how high yield bonds performed in various kind of crises that we've had recently. And so maybe just for example here, the subprime crisis in 2008, 2009, US stocks down 40 or 50%, treasuries or investment grade bonds just down a few percent, these high yield bonds down nearly 30%. And so just do not do a good job of protecting your portfolio, but don't give you the returns of stocks, that are a volatile investment. And so, if you want your money safe, the total bond market, investment grade types of bonds are very good for that. If you want growth, stocks have been much better, and you don't need to find something in the middle to try to do both of those at the same time.